Hello, good afternoon, everyone. Fáilte Roibh, you're very welcome to our multi-unit developments training session 6 on sinking funds. David Rouse is my name, advisor with the Housing Agency, and I will reshare my screen and go through some administration for today's session. This is the sixth and concluding session in our program of webinars for stakeholders in multi-unit developments and owners management companies. We hope you've found the program and series informative and educational as we have gone through the topics and the subject matter of the various presentations. A word about ourselves, the Housing Agency. This is the first session that you've attended. Pictured are our offices on Upper Mount Street, where we are located in normal times and where we hope to return to soon. Our mission is to promote the building of sustainable communities, and we work with the Department of Housing, Local Government and Heritage, with local authorities, approved housing bodies and stakeholders in the wider housing sector to deliver on that mission. Our website is housingagency.ie. The timetable for this afternoon's session, the presentation proper will begin at about 20 to 1. At 1:30, in a slight change to our usual format, we will have some surveys for you to participate in. So we'd be very grateful if you could keep with us in the presentation until certainly the surveys are done. Even if you don't have questions for the Q&A, we would be grateful if you'd stick around with us to complete the surveys, where we will be asking you to rate the overall program, to rate the overall standard of the presenters, and indeed we'll be asking you to indicate potential future topics for future training in the area. So again, we'd be grateful if you could hold with us after our presentation. Those surveys should take about 5 minutes to conduct, and then we'll move on to the Q&A for today's session. A reminder that all previous training sessions are available to watch back on the Housing Agency's YouTube channel. So if you access YouTube, search for Housing Agency, click into videos, and you'll see all of the previous 5 sessions available for your watch back. And you can see highlighted last week's session 5, which was on the role of the management agent and the PSRA. Some other housekeeping around today's session. Certificates of attendance, information on certificates of attendance is available on our website, and we will be dealing with those over the coming weeks. So there's no need to contact us. We will contact you on certificates of attendance for those who qualify in the manner outlined online. We'd remind you that the information and guidance delivered in today's session, and indeed in all the sessions, is of a general nature. Queries or cases or difficulties or concerns in relation to your own estate require examination by suitably qualified professionals in terms of the specifics of your case and your management company and your multi-unit development. So we would encourage anyone to contact their property management agent, their OMC solicitor, or indeed their accountant or other professional as appropriate. As you'll be aware, the event is being recorded in order that we can put it up on our YouTube channel in due course. For questions on the substance of today's presentation on sinking funds, please use the Q&A function. For queries or questions in relation to the audio or visual quality, please use the chat function, where my colleagues Tara Doyle and Sarah Kennedy are monitoring the session in the background, and they will respond to any queries on AV that you may have, but hopefully all will be well in that regard. We will email out to you a copy of the slides, so no need indeed to contact us in relation to a copy of the slides. We'll send them out to you. So our presenter today on the topic of sinking funds is Conal Toohey of Kane Toohey Solicitors. You'll be familiar, those of you who attended last week's session will be familiar with Conal. He's the managing partner of Kane Toohey. His practice areas include property and landlord-tenant litigation, managed developments, debt recovery, commercial litigation, and employment law. Connell graduated in law from UCD in 1991 and was admitted as a solicitor in 1994. So I would ask Connell to turn on his camera and turn on his audio, and I will pop Connell's slides up on screen. And over to you, Connell. Thank you very much indeed.
Thank you, David, and good afternoon. The agenda for today's presentation in slide 2 sets out what we're going to cover, so I'm going to run through that very quickly and then jump into the slides, finishing after, I hope, about 40 or so minutes to leave as much time as we can for questions and answers. So the agenda for today, we're going to look at what the practice was pre-MUDS Act. We're then going to look at the regulatory framework of the MUDS Act. We're going to then delve into section 19, which is the meat of today's topic, get into the detail of, well, what does expenditure and maintenance of a non-recurring nature actually mean? What can the OMC spend its money on, what it cannot? And then over the slide to the remainder of the agenda, we're going to be looking at the regulatory minimum amount. We're going to be then dealing with some technical issues around bank accounts. Won't spend too long on that. The rest of the agenda over the slide, we'll concentrate on the regulatory steps that need to be taken in order to spend your sinking fund, what the applicable voting majorities are, practical observations which should really and at all times inform our approach to today's topic. And then we'll circle back to some discussion points, throwing out some queries, not necessarily ones that we're going to be able to answer, but at least get us all thinking about what practical observations or issues might arise, and possibly for future regulatory framework. Who's to know whether more legislation may not be required as our learning curve goes up in terms of sinking funds and MUDS Act generally. So we're going to start with the pre-MUDS Act regime, and in simple terms, there was none. The purpose of the MUDS Act was to put a regulatory framework in place in order to ensure best practice when it came to how OMCs managed their affairs. Now, prior to that, many management companies, through their professional property management agents, were already operating very good practice. And there are examples of many management companies which were doing everything which, in fact, the MUDS Act now mandates. The practice, therefore, pre-MUDS Act, in terms of sinking funds, was that obviously anybody who is in the business would anticipate that there may be capital funding expenditure down the road, and to make provision for it would be a good idea. No more nor less than anyone else's private home, where you anticipate you might have to do works, you might save a little bit in order to be able to meet those works. The needs of such capital expenditure could obviously require a call on the members to increase their service charges, sometimes called at that time, and still actually a levy. I don't actually like that word. I think it's a bit of a misnomer and can be confusing. And of course, when a levy or a demand for a call on the members came through, it was subject to the usual cash flow difficulties associated with anyone having to fund expenditure which they hadn't planned for. Occasionally, I have in the past and pre the MUDS Act come across situations where OMCs had levied, again using that word, a sum of money on owners in order to take care of capital expenditure, in addition to the service charge which had already been incurred for that particular year. And there were times when members would oppose having to pay that levy, in quotes, and would argue that the scheme of arrangement as provided for in the lease, which regulates the relationship pre-MUDS Act between the parties, did not provide or give authority to the management company to raise a levy, and then you got into a bit of a dispute in court as to what the OMC could or could not do based on what was in or not in the lease. So over the page, we get into the regulatory framework, and I'm just going to highlight one exclusion to section 19. So section 19 is what is what the sinking fund is all about. But there's an exclusion under section 2.2 of the MUDS Act. It provides that units in a multi-unit development, which are residential units, and where the structure does not, nor it was ever intended to form part of the common areas, then Schedule 2 of the Act applies, and I'll come to Schedule 2 shortly. The purpose behind section 2.2 was to effectively put housing estates, which are comprised entirely of houses, but which manage their affairs through a management company, on a different footing to what we would ordinarily understand residential apartment complexes to comprise. And over the page, we'll see that at Schedule 2, it lists the provisions of the MUDS Act, which apply to developments caught by section 2.2, and notably it excludes section 19. And so for all developments, they are statutorily required to comply with section 19, save those developments envisaged by section 2.2. It doesn't come up often, but it is worth bearing in mind. Over the slide, we get into the actual meat of section 19. You're probably well familiar with it. Purpose of the fund is to do any one of A, B, C, or D. So if ever you're unsure as to what you can do with your sinking fund, go back to first principles and look at section 19, 1, where it sets out what you can do. It's refurbishment, it's improvement, maintenance of a non-recurring nature, or advice from a qualified professional relating to the foregoing. Having used those words, the Act then sort of leaves us hanging because it doesn't define what refurbishment is or what improvement is. And so in aid of today's webinar, I decided I'd just go to the Collins English Dictionary and see what they had to say about what refurbishment means and what improvement means. And those definitions are set out there and in the next slide. The second bullet point there is my attempt to capture the essence of what section 19 is about. And in my view, it's about capital funding. It's not to do with the maintenance, the repair, and the day-to-day expenditure, which is specified in section 18, and we'll come to that briefly shortly. Rather, it envisages a wholly different category of expenditure, of a capital nature. And we'll get into some examples of what that might be later on. Again, because of the absence of definitions in the Act, apart from and in addition to the dictionary definitions I've set out there, I've also had a look at other areas of law which might assist or guide us in terms of what improvement might mean. And there I reference section 45 of the Landlord and Tenant Amendment Act, which defines improvement. And a cautionary note, that obviously is a definition in the context of that landlord and tenant legislation. And so you should not take it that that is therefore what improvement means under the MUDS Act. It's a different context, but it can assist and guide us in teasing out the principle. Similarly, over the page, I reference what refurbishment might mean under the Value Added Tax Consolidation Act. And again, context is everything. That's a definition relevant to that act. But again, it could inform us when we're grappling with the principles. The final point is a very, very important point. If in doubt, you get advice from a suitably qualified person, whether that's an engineer, architect, building surveyor, in order to guide the management company and its agents in relation to what expenditure is envisaged and whether it could come within the meaning of Section 19. And of course, involve your lawyers as well. And a collective opinion might then be arrived at. Sometimes it's very clear that what you're anticipating spending the money on is captured by Section 19, and sometimes it is not. And therefore, if in doubt, get in suitably qualified personnel. Over the page then to maintenance of a non-recurring nature. So the Act goes on in section or subsection 2 to give some sort of helpful analysis as to what the Act means by the words maintenance of a non-recurring nature. And it doesn't do so by reference to examples of what that could mean. Rather, it takes a sort of an intellectual principled approach and says, well, in order for maintenance of a non-recurring nature to arise, 3 criteria must be met. It must be expenditure not generally incurred in each year. It must be certified as such by the directors and approved by the members at general meeting. You must comply with those 3 criteria in order to ensure that what you regard as maintenance of non-recurring nature comes within Section 19. Over the slides then, and there I've given some obvious, or at least what appear to me to be obvious examples based on my experience of refurbishment or improvement, lift replacement, roof replacement, and once-off remedial works. And again, I reiterate, if in doubt, take advice. What can you not spend the money on? Well, here regard should be had to Section 18.3. Section 18 of the MUDS Act deals with service charge expenditure. And that's what we understand to be the current the expenditure in the current year on maintenance, repairs, and the ongoing and associated expenses, which are going to be incurred throughout the year of a recurring nature. And the paragraphed, the additional items there, repairs, waste management, are taken directly from Section 18.3. So it follows, therefore, that if what you anticipate spending your sinking fund on falls within 18.3, then you're not allowed to spend your sinking fund on it. So Section 18.3 can be a useful, handy list to benchmark against that which you're anticipating spending your sinking fund on. And if it falls within 18.3, then Section 19 doesn't arise. On to the next slide. There's an anomaly in my view, in the Act, where Section 18.6 states that expenditure on matters which are the responsibility of the developer cannot be undertaken unless certain criteria are met. And what that was designed to achieve was to ensure that a management company wasn't lumped with the expense associated with, say, snagging of a development that had just been completed, because patently such snagging items would be a matter for the developer. And then the voting thresholds are designed to ensure that a developer who maintains voting rights in a development wouldn't use those voting rights in order to vote through at general meeting such expenditure. And so there's a threshold set by reference to 65% of the units having been sold. Now, there's no similar restriction in Section 19. Section 18.16, which deals with service charges, as you know, provides that any excess may, so there's a discretion, may be applied on expenditure which is incurred by the sinking fund. And then the anomaly, or at least a question mark that I have in any event, is, which begs the question, if the excess caught by 16 is applied, is it caught by the limitation in Section 18.6? My guess is probably not. I think once the monies are applied, so once the excess from the service charge is applied on Section 19 expenditure, I think it's probably considered as part of the sinking fund, and it's not caught by that limitation in Section 1816. It doesn't arise, at least in my practice, I haven't seen that arise. What then are the regulatory minimum amounts? Well, it's set at €200 per unit, which is, I suspect, not sufficient to build up any decent sinking fund. But in any event, it's the legislature's attempt to set a threshold. And of course, the members have the right to increase that sinking fund contribution and set it at a higher amount. And that's specifically provided for in the relevant statutory section. So that's all very good. We know we want to set a sinking fund contribution, but what informs the amount? We can't arrive at this figure in the abstract. And so it's incumbent on the board, if they're going to put a figure to the members at general meeting and ask those members to vote on and to pay over that sinking fund contribution, then it must be informed by some objective assessment as to what could be the likely refurbishment, improvement, or maintenance going forward. And to that end, of course, the board would be well advised to seek suitable advice from somebody who can guide them. And so, in my view, the last bullet point, I emphasize this point, the board should be advised of the need to prepare or procure a report on likely capital expenditure over the lifetime of the building. I myself have been surprised over the years when you get into it as to how relatively short the relevant professionals say is the lifetime of a building. And I will certainly defer to the experts in that area, but I have heard estimates of the average lifetime of a roof at being 25 years, of the average lifetime of a lift being maybe 15 or 20 years. And which obviously therefore has to inform the OMC in terms of appropriate planning for that day when that expenditure falls in. Over the page then we get into a little bit of technical discussion about separate bank accounts. I'm going to fly through this fairly quickly. And the relevant enactment, the relevant section states that the contributions made to the sinking fund shall be held in a separate account. It doesn't say bank account. And if you'll recall in the slides dealing with the agenda, I had made a point that the MUDS Act refers, so this is slide number 3, the MUDS Act refers to account, not bank account. But I think when you intermingle, if you like, the Property Services Regulation Act, and in particular the client money regulations made under it, with the MUDS Act, I think it's fairly clear that what is meant is in fact a bank account for the reasons I outlined there. The PSRA Act defines relevant account as an account into which monies are paid. And then the regulations themselves refer to the payment of the sinking fund into their relevant account. And in my view, what I understand that to mean, and what I understand reflects good practice in any event, is a separate bank account. So the Section 19 provides for the making of regulations prescribing those matters that I outlined in the second bullet point. No such regulations that I am aware of have been made. Maybe they'll come in due course, and I don't know if they're in the pipeline. Somebody else might, but I have seen no commentary in relation to it. Client money regulations under the PSRA are important because it sets a regulatory framework, statutory framework, in relation to how members' funds should be held and accounted for. the regulations, they provide at bullet point number 2 there, that the licensee who receives the money in respect of a service charge or a sinking fund shall pay it into the relevant account. And we've already looked at what relevant account means under section 47 of the Act. The client money regulations then link in to the MUDS Act by saying that the sinking fund, that phrase as used in the regulations, is what is meant by section 19 of the MUDS Act. So they clearly link the two. And they require the licensee, which is the property agent, to maintain separate client's ledger, a separate annual service charge account, and a sinking fund contribution account, which is effectively good practice and also now statutorily mandated. So over the page, this is basic accounting, and no different actually to basic accounting obligations placed on solicitors or anybody who, well, not anybody, but certainly on solicitors who handle client funds. There must be a record of those funds coming in, recording the transaction in a journal in respect of all funds received, in respect of service charges and sinking fund contributions. And then the regulations themselves go on to deal with the minimum accounting records which must be maintained. And this was dealt with in greater detail in last week's webinar. So on to the next slide, we then deal with, well, what can, what are the regulatory steps to be taken to spend the sinking fund? So where the expenditure relates to maintenance of a non-recurring nature, section 19 sets out what it must do. And we've touched on this earlier. It's expenditure which is not generally incurred. It's certified as such by the directors and is approved by the members. I'll just pause lightly on the certification by directors. Unless directors have specialist knowledge, their ability to certify something as being expenditure on maintenance of a non-recurring nature is only as good as the advice that they are given. And so a board, before it certifies, should be satisfied that it has appropriate advice to back up any certification that they might be giving, and which is relied on then in turn by members at general meeting. Somewhat curiously, the criteria that determine whether expenditure relates to maintenance of a non-recurring nature don't apply to refurbishment or to improvement. I don't know why that is so. Seems to me a lacuna in the Act. But as my last bullet point mentions, I think as a matter of good corporate governance, they should be treated, i.e. refurbishment and improvement, in exactly the same way as you approach the issue of maintenance of a non-recurring nature. I.e. is the refurbishment or the improvement, is it such that it's not generally incurred? Can you get it certified by the directors and then approved by the members at general meeting? The members' approval and the applicable voting majorities. So there are two resolutions which require members' approval under section 19. The first we've touched on is the expenditure on maintenance of a non-recurring nature. Can that be approved by the members, or it must be approved by the members to be so? And then the amount that's going to be paid into the sinking fund each year. So those are the two types of resolutions that must be put to the members, depending on circumstances. The curious voting threshold set by section 18 for service charges is not replicated in section 19. And so, and section 19 is silent in relation to the voting threshold, which means that we must default back to the Companies Act to find out, well, is there any guidance there as to what the appropriate thresholds for the voting majority in order for a resolution to be passed? Under the Companies Act, certain businesses defined a special business, thus requiring a super threshold of 75% or more, or of those members voting and in attendance. However, a resolution under Section 19 is not one of the matters referred to by the Companies Act as required in a special resolution. And so as there are no special provisions dealing with such a resolution in the Companies Act, it defaults to the ordinary resolution threshold, which is 51%. Over the slide then, into practical observations. So these are, I think, discussion points arising and which should always be at the back of our mind in terms of how we approach this area. No two situations are the same, or at least not in my experience. And I'd emphasize again the following points: retain professional advisors, assess the lifespan of the building, be mindful of the limitations in terms of what any building suffers by virtue of the passage of time. It's not going to stand forever and a day without having to be attended to. And whilst it can be difficult sometimes for us to focus today on something we think may happen in 15 or 20 years' time, bear in mind that these are people's homes, and there is a commonality of interest amongst all members to ensure that adequate planning goes in to maintaining those homes. Facilities management, I raise that because it's a different animal, if I could use that word, to property management. And for many OMCs, it's simply not necessary. But as the relative complexity of buildings increases, in particular in the context of environmental friendly systems, of perhaps more complicated heating systems, energy storage systems, you can see how facilities management may begin to creep in increasingly into the categories of work which property agents may have to address their minds to, and which OMCs may have to pay for. Which is the last point there, that if in fact facilities management is going to form part of the retainer for the OMC's agent, well, then that should be specified, agreed, and set out as part of the letter of engagement. Discussion points. Should a departing owner get their unused sinking fund contribution back, with the corresponding obligation on an incoming purchaser to replace it? Or is that part of the bargain? The last point there, caveat emptor, is a warning to purchasers. When you're buying in a development, you're entitled to raise certain requisitions on title. And you'll see there that under the Law Society ROTs, or requisitions on title, certain information is sought from the vendor in relation to the amount of the sinking fund, and in particular, where there's any possible claims against the OMC funds. And I'm going to pause and expand on this point a little bit, because it's something I've come across regularly enough over the years. If the purchaser is making an informed decision whether to buy or not, then this information is absolutely crucial. They will want to know what's in the sinking fund. If there's zero, then depending upon the age of the building, that purchaser could be stepping into what could be a potential significant expenditure going forward. If there's a reasonable sinking fund built up, then that gives them some comfort that a call made on them will not be as great as it would otherwise be. The second point there about requisition 3613 is very important. If the OMC anticipates that there's going to be significant expenditure because it knows of a particular remedial work that needs to be done, And if in answering the requisitions, the managing agents, which invariably happens, they pass the information to the vendor solicitors in order for the vendor solicitors to answer the requisition. And if the answer to that requisition is no, but in the background, the agents and the OMC are aware that there is going to be expenditure in respect of a certain category of remedial works, then insufficient and incorrect information has been given out. And so the purchaser ends up relying on that, purchase the apartment. And then the following day, they're met with a call to contribute towards the sinking fund for X number of euro. You can imagine how, in that circumstance, the purchaser might feel somewhat aggrieved, because had they known before they bought that such a call was coming, or that significant expenditure was on the tracks, such as to amount to a claim against the OMC's funds, they may have decided not to buy. And you then get into a terrible row about misrepresentation and possible claims for damages arising. The second bullet point there touches on an issue as to whether sinking funds can be set up for separate blocks in a development. So if there are 6 blocks of residential apartments located in one development, would it not make sense to have 6 separate sinking funds to address Section 19 expenditure? Well, yes, it might, but to be honest, it's irrelevant, because it's going to be the scheme of the lease which determines how the expenses are dealt with. And there's a fundamental distinction between segregated budgets and integrated budgets. And whilst on a simple level, it might be very attractive for members in a multi-block development to segregate their funds so that a call to replace the roof on block 1 is a call on the members who own units in block 1 only, thus excusing other members in blocks 2 to 6 of having to subvent that. Happy days, say the members in blocks 2 to 6, not our problem, we'll leave it to the members in block number 1. And of course, that could only be done if that is the nature of the service charge scheme of arrangement provided for in the lease. And if the lease does not provide for that segregated budget, then it cannot be done. And to do so is in breach of contract. There are various pros and cons for a segregated versus an integrated budget. Effectively, the nature of the scheme of the arrangement is effectively set by the developer when they set up the scheme in the first place. That's not to say you cannot change it during the course of the development, or indeed when the control of the OMC is passed to the members, but it's complicated and would certainly require an engagement with members and thereafter an application to court. The apartment planning guidelines are worth a mention because they do reference life cycle reports in the context of managed developments, the purpose of which is to manage and reduce cost for the benefit of residents. And it also references the fact that compliance with MUDS Act and the establishment of a sinking fund may require appropriate planning conditions. Over the page then, a financial example. And what I mean by that is this. If an OMC is faced with significant expenditure, which, if levied, to use that word again, in 1 year would give rise to a significant financial burden on individual members, that may be unavoidable. But at the same time, it could be managed in a certain way. And I have certainly come across examples where what at first blush appears to be an almost insurmountable financial problem because of the size of the expenditure required, on a more nuanced analysis can be managed such that the hit, if I could call it that, does not come in 1 year. And that is informed by, again, suitably qualified advisors looking at what, in fact, is required in terms of the work. And certainly, if the work can be broken down into urgent work, less urgent work, and non-urgent work, and in turn then those pieces of work scheduled to take place within different years, then you can see how what at first blush appears to be a very big number could perhaps be broken down into constituent budgets in order to defray the cost over a series of service charge years, to enable people, give them some breathing space in order to get the funding together. I'll make short mention of section 17. This envisages a statement that must be put to the members each year dealing with the items outlined in section 17. And one of those items outlined in section 17 is the necessity to reflect in that report the expenditure on refurbishment, improvement, or maintenance of a non-recurring nature in the current year. It does not mandate the inclusion of that information for a period of time beyond the current year. Although in my view, good practice would dictate that the board should address its mind to that and should, as appropriate, bring it to the attention of the members at general meeting. The last bullet point there, can the works and hence their costs be spread over a number of years? And I've already dealt with that, and the short answer is yes, subject to advice from suitably qualified advisors. It may be that that big number cannot be broken down over a number of years because all of it is required to address urgent matters which simply cannot wait. That brings into focus a whole different issue, namely how you fund such calls. That is probably the subject of a different webinar than today's. That concludes my presentation, and I hope I've left adequate time for questions and answers. Thank you.
Thank you very much indeed, Conal. Before we get to the questions and answers, as I mentioned at the outset, we're going to run 3 short polls, and we'd appreciate our surveys. We'd appreciate your input on them in order to get feedback on the overall presentation. So I'm going to launch the first survey here, and hopefully you can see it on screen. Tara or Sarah might confirm that it is visible on the screen, and
it is,
we would
yeah.
ask you, apologies, that is poll number 3, but look, I'll let it run anyway. We're asking you what topic in future would you most like to see addressed by a future session, future training session. So the poll is entirely anonymous. We don't know your answer. We can't attribute a particular answer to a particular individual. So we're asking you to express a preference here about a particular topic you'd like to see in future. And if a topic that, if you have a topic in mind that's not listed there, please drop us an email, mud@housingagency.ie, mud@housingagency.ie. So I'll run that poll for another 5 seconds or so. So thank you to the about 170, 180 of you, which is about a 70% response rate, which is pretty good. For anyone that hasn't answered it, be assured that the poll is anonymous, so your reply cannot be attributed to you. So we'd ask you to
Hi all, apologies. I think David's internet has maybe stopped working for the moment. Thank you to everybody who answered those polls, and we might end those now and move on to the second, just while David is rejoining. So I'm going to end that one. David, you're back. You're on mute.
Apologies about that, folks. There seems to have been some difficulty with connections.
We
just the nature of.
We just ended that poll, David. So you're ready to go to the next one whenever you are.
Great, thanks for that, Tara. Such is the nature of live broadcast. I launched the what was intended to be the first poll. So please rate the overall program of webinars. So this is your experience of the series in its entirety. So your overall experience of the 6 webinars. Obviously, this will apply to those of you who managed to attend all 6, but indeed those of you who attended maybe 4 or 5 of the sessions would also give us your feedback. Again, a reminder that these surveys are entirely anonymous, so we cannot attribute your response to an individual attendee. And I can see that we have about 70% of those of you who are here have kindly responded. So anyone else who wishes to respond, you might please do so in the next number of seconds, and we'll conclude that presently, and I'll move on to the next feedback poll, which would be the second. Well, it'll be the final poll. It was intended to be the second one. So I'll end that now, and thank you very much for those of you who have responded. And the last poll, the last survey, again entirely anonymous, is just to rate the overall experience of the presenters. So we'd ask you to give us your views on that. Again, thinking back over the 6 webinars, we'd ask you to give us your experience of the presenters. Very good, good, fair, poor, or very poor. So again, the survey is entirely anonymous. We can't attribute your response to you. We'd ask you to help us plan future events by giving us your feedback on that. It's possible that those of you who are using particular web browsers or who are dialing in over audio, unfortunately, won't be able to participate in those polls. But I can see from the response rate that most of you can indeed. So I'll end that poll, and I thank you very much for your cooperation, and apologies for the slight dropout earlier on. As I say, such is the nature of live broadcast. Moving on then to the Q&A, and I'd ask Conal perhaps to turn on his camera and to unmute himself there briefly, would be great. We did receive a number of queries in advance by email, so those of you who are good enough to send those in to us over the last number of days and weeks, thank you very much for those. And we will move to quite a lengthy first query, is in relation to, I suppose, something that Conal touched on towards the end of his presentation in relation to remedial works. And the questioner says, we're planning on raising a special levy in line with the normal service charge appointment percentages, and looking at some of our sinking fund to part fund the works or form a bridging finance until the remedial work levies are paid. And the questioner asks, I suppose, for some guidance around that. So, Conal, I think you dealt with a lot of that in your presentation, but if you'd any round out comments on that.
Sure. So that first question, it references the phrase special levies in terms of expenditure necessary for fire safety works. And the reference to special levies, I think, is a bit of a, as I mentioned earlier, is a bit of a misnomer. There's no reference to special levy or to the noun levy in the MUDS Act. It does use the verb levied, but only in the context of a contribution, which is what Section 19 talks about. And I referenced earlier, in the pre-MUDS Act regime, there was a practice whereby OMCs, acting through their agents, would distinguish from service charges a call for monies by reference to this phrase special levy, and it could get you into terrible difficulties if it was challenged on the basis that there's no reference to special levy in the actual scheme of arrangement which is set out in the lease. And then you're sort of backpedaling and trying to make a convoluted argument that special levy is really a term of art and that really what you're talking about is in fact a service charge within the meaning of the scheme of arrangement as set out in the lease. Some of the leases would occasionally reference sinking funds, but not all. And so using it in a MUDS Act environment, again, it just has that possibility of why the possibility, gives rise to the possibility of confusion where you're using phraseology not used by the Act. However, it does raise an issue, and I'm not sure the answer to this, but it's something that's sort of occurred to me over the years. The Act under Section 19 envisages forward planning. It envisages a measured, calm, logical, rational approach to the incurring of expenditure of a non-recurring nature and how you provide for that through a sinking fund. And you have a meeting and you ask the members to vote, and then they vote, well, we're going to put X into the account and that's great and everybody pays it, and that's fine, but life isn't like that. And sometimes issues just come out of the long grass that no one anticipates, and there's a little bit of panic and there's a little bit of, oh my gosh, how are we going to deal with this? We've already gone to the members at general meeting to get the service charge for the year. We've already gone to the members in order to get the sinking fund contribution. And suddenly now we're faced with this unforeseen expenditure of a non-recurring nature. It needs to be done urgently, but we've already been to the well in accordance with Section 18 and Section 19. Can we go back again? And I'm not going to give specific advices on that, because everything turns on its own particular facts, on the particular funding arrangements, whether the powers of the company are such as to entitle it to borrow, if in fact it can get borrowing. And that's, as I mentioned earlier, a whole separate issue for a different webinar. But I would caution people to against the use of the word special levy, because it's not referenced in the Act. And if you want to protect yourselves from a challenge, then you're as well to bring yourself within the meaning and the wording of the Act as close as you can.
Great. The question is, a questioner has asked, if there is a surplus of service charges at the year end, can members request to transfer the surplus to the sinking fund? And I think you've dealt with that.
Well, it's not so much actually, and there's a nuance here. Section 18.6, which deals with Section 18 dealing with service charges, subsection 6 says that any excess in the service charge may be used on expenditure envisaged by Section 19. That's not quite the same as transferring the excess into the sinking fund and just letting it sit there. Rather, Section 18.6 says it can be used on expenditure. So there's a slight difference there. The other thing that can be done with the excess of on a service charge, and this is mandated by Section 18.14, is the excess can be taken into account when setting the service charge for the following year. And equally, any underfunding in the service charge, or the inadequacy as the Act calls it, it can be added to the following year. Again, that's all very well in principle, but practicalities, if there's an inadequacy in your service charge budget, then you got a problem and you got a cash flow problem. So there's a slight disconnect here between the Act and practice.
Certainly, in the context of your response to questioner 1 and indeed questioner 2, we would hope that the subject topics of earlier sessions in relation to service charge, debt recovery, the MUD Act, company law, good governance, etc., would feed into that calm and planned approach to finances, including the sinking fund. So moving on to another question is can members be involved in project plans, priority and approval of quotes? So I suppose this comes down to, maybe it's not directly a sinking fund question, but it's a question around representative democracy almost, that the members are elected directors to do the business of the company.
Yeah, and it gives rise, the question is a good one because it poses a number of important issues of a political, with a small p, nature. I personally can't overemphasize the importance of communication between members, directors, and agents. The single biggest cause of conflict in OMCs is lack of communication. People don't know what's going on. Information is siloed, and people then assume the worst and take very trenchant opinions, dig themselves into a trench, and it can make for terribly knotty problems. And so if and actually, let's just track out a practical issue. A board meeting occurs and the agent is invited to attend, and the agent has discovered there's an issue in the development. Let us say absence of fire stop. That will cause everyone's heart to momentarily stop a little bit, I guess, and people will be absolutely concerned to ensure that obviously the issue is addressed appropriately. It's health and safety. It's a serious issue. You don't mess around with this. And so you're going to commission a report to find out, well, to what extent is that issue, if it's been discovered in one apartment, is it to be found development-wide? And then to what extent, if it is development-wide, will it require to be addressed today, tomorrow, or next year? And what's the cost of doing it today, tomorrow, or next year? And so there's a process that's going to have to be gone through. Now, on the one hand, the board is charged with the management of the OMC. That's their job. It is not the job of the members to manage. The directors go to the members at general meeting once a year. That's the members' opportunity to voice issues, raise questions, and have that discourse. But if that is the only point of contact between members and the board, then something's not right. Or alternatively, it's an extremely well-run OMC and development with no issues. And so going back to our example, the board is faced with these issues. Well, the board has to look into that. They're not going to go running off to the members saying, we've got this problem, we got this problem. They have to find out, well, what's the extent of the problem? So there's a little bit of preparatory work to be done. And then in a calm, efficient, and rational way, you gather that information, and then you go back to the members by way of an information circular, by way of a meeting, just to discuss, to bring to the members' attention the fact of the problem, what the board is doing about it, what steps they're going to take, what the possible outcomes might be. And what you're doing there is you're giving members information so they can wrap their heads around the issue, just as the board has been able to wrap its head around the issue. And that way, when everybody understands what the issues are and where things, if I could put it that way, are not sprung on members at the last minute, it's much easier to manage the process. So I cannot overemphasize the importance of communication. However, and there's always an however, the particular question asked was, can members be involved in project plans, priority, approval of quotes? Now, generally, those are jobs for the board, the agents and the advisors. For example, going back to our example, where the agent identifies an issue. Well, the first thing he's going to do is he's going to choose a suitably qualified advisor. You may get quotes from a number, and then the board will choose one based on advice from the agent. The board is not going to go to the members at general meeting and say to the members, we now have 3 quotes. You wouldn't mind voting on that now, would you? And then they get the 3 quotes. They appoint the expert, and then the expert comes back with a report, and the report gives a number of options. And then it would be a waste of time and a dereliction of duty on the part of directors were they to default at every decision-making step to members. That is not how it works. But there is a bit of there's a gray area here where whilst not defaulting to members at general meeting at every hand's turn, the directors should, of course, keep the members informed. And there will ultimately become, there will ultimately come a decision to be made by the members at general meeting. The directors and the agents and the advisors having done their respective jobs to get it to a point where a decision can be taken. And the reason why this is important is also that if members are in the habit of giving their views, whispering in directors' ears, or not shouting at directors at a meeting, and intermingling into what should be done by the directors, then that member or members, they could risk being deemed a shadow director. And a shadow director is someone whose directions the company is inclined to follow, even though they are not in fact a director. And so there are corporate governance issues here as well, which have to inform a proper approach to it. Sorry, I've gone off on a bit of a tirade there, but you opened it up, so there you go.
It covers a number of touch points, if you like, across the general management of an owner's management company, and indeed our session on company law dealt with some of those matters, including shadow directors. So maybe the questioner might, if they hadn't had an opportunity to look at previous sessions, look back at those, which are, as I mentioned, available on our YouTube channel. If to jump to another question, which is sort of service charge and sinking fund related, if there's an error in a calculation for 1 year, and if there's an error in the apportionment of the service charge and sinking fund to units, what happens, I suppose, to shorten the question?
So where there's an error in the calculation, so as I understand the question, a vote has been put to members to apportion the service charge or the sinking fund?
Well, I think both, probably. Both. Okay. The overall contributions in respect to both. Okay,
so meetings have occurred, the appropriate approval has been secured by the members of general meeting, and then before the demands are issued for the payment of the appropriate apportionments, it's discovered that the apportionment used to calculate a member's obligation is wrong. Well, when you discover a mistake, and this is no more nor less than what we were all told when we were growing up, you put up your hand and you say, that's my mistake, I am sorry, and how can I fix it? And from that really just basic approach, it follows that, of course, you could, in my view, you should not issue the service charge demands because you're compounding the error. What you should do is you reconvene the members at general meeting, having done the correct calculation, and you explain in your notice convening the meeting or the letter serving the notice why it is that you're now having to bring the members back to another meeting, imposing upon their time, and explain what the issue was, what the error was, explain that it's been corrected, apologize, and ask the members to come back to vote on the correct apportionment. Otherwise, if you don't do that and you wait till the following year, the problem has now been utterly compounded because people may have now paid their service charge based on an incorrect apportionment. So now you've got to correct that in the next year with a consequent debiting issue arising. And you're just making the problem worse. So if an error occurs, just call it and fix it.
It comes down to communication again.
Absolutely.
Between members and directors. A question came in. We're a residential estate with an OMC, so I take that to mean purely a housing estate. Why do we need a sinking fund? Can it be capped at a certain amount? Our common areas are comprised of grass areas and flower beds, so I think this might be the exclusion you mentioned in relation to Schedule 2. So it might be just worth going over that again for people.
Yeah, so Section 2.2 effectively excludes developments which are comprised effectively of standalone houses sitting on their own plots where it's not envisaged that the structures are part of a common area structure. So your classic case is a housing estate, not taken in charge, but where, or indeed in some cases that I come across, it's a hybrid. Some parts of the estate are taken in charge by the local authority, and other bits are not. Don't quite know why that's the way it is, flowing from whatever planning they were given, perhaps. And in those hybrid models, that which is left to the management company to manage is in fact very little. So, for example, if the housing estate, or if the local authority has come in and taken in charge the drains, the roads, the footpaths, the lighting, there may be, for example, a green area that's retained. Which has to be upkept by the OMC. And you can see there where obviously it makes no sense to have a sinking fund, which is why Section 2.2 mandates that and excludes from those developments the obligations under Section 19.
We have a number of questions about the €200 amount nominated in Section 19. And a number of questioners have asked, can it be higher and can it be lower at the discretion of the members? So I think it might be worth going over that particular nuance for people, that the €200 is an indicative amount. Is that a fair comment?
Yeah, so on first blush, I think many people would assume, well, 200 is the minimum. So you've got to put 200 in per unit, but you can certainly increase it at general meeting by an appropriate resolution of the members. But in fact, when you look at the wording of Section 19.5, that's not quite the case. So I'm going to read out the wording. Subject to subsection 6, which is irrelevant to the issue we're considering, the amount of the contribution to be paid as respects a unit by each unit owner of such a unit to the sinking fund in respect of a particular year shall, so that's mandatory, shall be the amount of 200 or such other amount as may be agreed by a meeting of the members as their contribution in respect of the year. So there's an option given. What the legislature is stating is it shall be 200 or such other amount. It doesn't say such other amount as shall not be less than 200. It says or other amount. So in fact, on a pure literal reading of the section, it could be less than 200 if the members so resolve. But the members, and in particular the board, who are putting the proposal, would be well advised, if you're going to drop it below 200, you want to have a good reason, i.e. no anticipated expenditure coming down the line to do so. And it might be a brave board that elected to do that, because I'm not aware of any development that couldn't possibly require capital funding over the coming years.
A question in relation to, I suppose, members' rights. If members are dissatisfied with the way that a board is approaching the funding of the sinking fund, and again, this falls a little bit outside the specifics of Section 19 and into other sections of the MUD Act, but maybe you'd comment on that for us, please.
In terms of the...
If perhaps they're using service charge budgets to address sinking fund matters.
Well, they shouldn't, I suppose, is the slightly short answer to that. I mean, they just shouldn't.
I suppose it speaks to the wider issue of remedies under the MUD Act and its circuit court application and so on.
Yeah, there is provision in Section 19. I'll just find it now. Yeah, Section 19.7 says the contributions made to the sinking fund shall be held in a separate account. And they shall not be used for expenditure on any other matters. And then it goes on to say under the next subsection, where a dispute arises as to whether assets of the owner's management company should properly be applied to the sinking fund account or the annual service charge account, then the dispute is subject to an application under Section 24. Section 24 is the process by which you get the issue before a circuit court judge. And so what does that mean? It means that where there's a dispute, maybe between the members, maybe between the members and the board, as to whether what's euphemistically called the assets of the OMC should go into the sinking fund in order to be used to deal with that kind of expenditure, into the service charge, to deal with other. Well, if there's a row, off you go to the circuit court. Well, that's great. Except from a practical perspective, the process under the circuit court rules by which you get before a judge of the circuit court is by way of what lawyers will call a plenary route. So you have to issue what's called a civil bill. And that's, again, without getting into too much technical detail, it's a much longer process than could otherwise have been achieved by the court rules. And if I was being asked to give a view as to how we could tweak the system to make for better use of resources and a quicker resolution of issues, it would be to look at that issue. Because if I go down the route of the circuit court rules, which I'm mandated to, I'm into a full circuit court action, which could take months, if not longer, to resolve. And that could be easily tweaked by giving practitioners the ability to get the issue into court by way of an originating notice of motion, which is a much quicker process. And you get the issue before the court quickly, in particular where there's an urgency attaching to it. And that's not to say you couldn't make an interlocutory application in the context of a longer claim where the circumstances merit it. But suffice it to say, unless there's screaming urgency, which justifies an interlocutory application for an injunction, you're into a process that will take a little bit of time to get resolved. And that's why the Act says mediation, which is why if there's a row, get mediation out there and offer it up first thing. If you're acting for an OMC, or if the OMC is getting into a dispute or members are getting into a dispute, someone should be banging the mediation drum. It's a very effective resolution mechanism.
Great. A quick question. How is sinking fund amount apportioned? Is it the same as service charges, or is it divided equally over the units?
It should be units. It should be divided in accordance with the scheme of the arrangement. So whatever that scheme says, it might be, it sets maybe amounts by reference to whether the apartment is a 1, 2, 3 bed or a duplex, and it might specify certain amounts. It might do it on a square foot apportionment. Whatever the basis of apportionment is, that is which guides, well, not guides, that's what sets how the sinking fund is apportioned.
So when you say that the scheme of arrangement or the scheme of the development, it's the lease effectively?
Yes, because it's important to bear in mind that while the MUD Act does set a statutory framework, there's also a contractual framework, and one doesn't oust the other. So if, for example, someone was to make to me the argument, well, hold on, the MUD's Act at section 19.5 talks of €200 per unit. So yeah, well, that's what we're doing. It's €200 per unit. But you could leave yourself open to the argument, well, hold on, the scheme of arrangement under the lease provides something very different, and that it's a square foot apportionment. And therefore, if I'm a 1-bed apartment of 500 square or 600 square feet, why am I paying the same sinking fund contribution to somebody who owns an apartment 4 times my size, and where under the scheme of arrangement, that disparity is recognized by reference to an apportionment on a square foot basis? And therefore, I say contractually, that person should be paying more, or I should be paying a proportion less. And the imposition of a statutory enactment interferes in my property rights and can't do that. So I think the safer thing to do is to follow the service charge, the apportionment in the lease. I say that in the abstract. They're always going to turn on individual facts. It will depend on what the scheme of arrangement says.
Very good. We'd echo the comment that in particular cases, people need to get advice from their OMC solicitor or from their property management agent or other professional as appropriate. Look, it's 1:45. We'll bring matters to a close by thanking Conal for his presentation, by reminding you all that the slides and a link to the recording will follow by email over the coming days, as will certificates of attendance for those who have met the qualifying criteria. In the meantime, we would mention to you that there are plenty of resources and other information available on our website, housingagency.ie. Please drop us an email, mud@housingagency.ie, and we would say thank you very much for participating in the surveys. Renewed apologies for the slight communication blip during the polling. We'll say thank you to Tara Doyle and Sarah Kennedy in the background, who assisted very ably, as required indeed today, on the technology. We thank you all for your attendance. Hope you found the programme of webinars of benefit to you in your estate and in your owner's management company. Thank you very much indeed. Slán Tamil.